Last week, the S&P 500 had its largest weekly gain in over 45 years, and it did it in only 4 days. Now, we're still about 18% off of the highs that we saw in February, but the market has rallied over the past 3 weeks and is up 25%. Hopefully we're going to be able to continue this momentum into earnings season. In this week's video, I'm going to be covering the news from last week, Jared's going to be covering the returns, and Michael Tedeschi, our wealth management advisor, is going to be going over the key levels for both the S&P 500 and oil. Hope you enjoy.
Now, as Matt just mentioned, this is one of the strongest weeks that we've seen out of the U.S. markets in decades, as each of the four major U.S. indexes that we track all up over 10%. The NASDAQ was up just over 10%. The S&P 500 and the Dow Jones were up around 12% each. The Russell 2000, if you watched our video last week, I talked about it being a lagger, and we wanted to see what the Russell 2000 was going to do in the coming weeks. But the Russell was actually up over 17% just last week. Now, year-to-date numbers, the NASDAQ is down under 10%. The S&P 500, Dow Jones, down about 13.5 and 17, respectively. And the Russell 2000, even though it was up 17% just last week, still down 25% for the year. And if you're not familiar, the Russell 2000 consists of mid and small cap companies. So whenever investors are looking at taking a little bit more risk in the market, that's basically looking at companies that are in the Russell 2000. Now, I also did want to mention here, as you can see here, the S&P 500 is down about 13.5% for the year, but it's down about 18% from the February highs, even after about a 25% move that we've seen out of the S&P 500 over the past 3 weeks. So it's interesting to see what's going to happen here out of the markets moving forward. Foreign and emerging markets were also positive last week, with foreign markets up about 9%, while emerging markets were up about 7%. And now both foreign and emerging markets year-to-date are down around 20%.
Morning, everybody. Mike Tedeschi with this week's chart breakdown for you guys. Last week we had a spectacular rally. The markets finished up well over 10%. However, what I wanted to look at here today was where we stalled out. The S&P 500, and this is a daily chart going back until last June, rallied last week right into the area that was support from August and September of last year. When something acts as support, once we fall through it, that area acts then as resistance. So that's that big overhead battleground that we need to be paying attention to. Now, what I will say is support is not a single number and resistance is not a single number. They are zones. And really the price action zone that we're looking at here is going to go from about that 28.20 all the way up to about that 29.20. Bulls need to get it back up over that 29.20 for us to be able to see that continued rally and potentially that V shape. If we fail here, that would not be good, and so that's why we're paying very close attention. The other piece that I wanted to talk about here is oil, and this time we're actually going to go back and take a look at a chart going all the way back to the 80s. Last week we looked at a 20-year chart. This week I wanted to look all the way back at the major support zone that goes back decades. And what we see here is there is a very clear area right at about this 18 zone that splits this ultimate box in half down here. If we fall underneath of that level, the next area of support goes all the way back to 11. Oil has basically traded in between that 10 and that 23, 24 zone for a number of decades back in the 80s and 90s, only leaving that box a couple of times. That is why what happens here is so very, very important. If we can't hold up above that 18 zone, that would put us back towards 40-year lows.
The first news story that I wanted to cover is that we finally have an agreement that we're going to be reducing the amount of oil being produced around the world on a daily basis. OPEC is going to be cutting 9.7 million barrels per day. The US, Brazil, and Canada are going to be contributing 3.7 million barrels worth of a cut, and the rest of the G20 states are going to be contributing 1.3 million barrels per day cut. Now this is going to be a global reduction of about 10% per day. Now we're going to see if this is going to be enough to really stabilize oil prices. As Mike mentioned, we haven't seen prices like this since the 80s. The next news story that I wanted to cover was the Fed's plans to help stimulate the economy. Last week they announced that they're going to be putting in $850 billion to help the overwhelmed coronavirus loan program. Also, they said that they're going to be backing municipalities and states with $500 billion. This reassured investors that the credit quality for municipalities is going to be backed by the Fed. That news really helped stabilize the bond market last week. And the last news story that I wanted to cover was just some updated information on the coronavirus. Here in the US, we're sitting at right around 560,000 cases and around 22,000 deaths. Also, an additional 6.6 million people filed for unemployment last week, and now we're sitting at around 17 million people over the past 3 weeks that have filed for unemployment. But we're starting to get some good news from the government, and it looks like they're shooting for the beginning of May to start reopening parts of our country. Thanks for watching. This week's going to be an extremely important one, as not only are we at a key level on the S&P 500, we're also running into earnings season. So we're going to start to see the impact of the coronavirus has had on earnings, but what we're going to be paying very close attention to is what the CEOs are going to be saying on their conference calls about guidance for the rest of the year. Make sure you subscribe to our channel and hit the notification bell.